NIO started 2021 with a strong result by scoring its best quarter on record quarterly EV deliveries. NIO is still a very young company, founded in 2014 and had little experience in vehicle manufacturing when it came on the market. But today, NIO stock scored an EPS rating of 51 out of 99. EPS rating is comparing a company's earnings growth versus other companies. NIO stock has sold off sharply since 2020 and continues the strong momentum in 2021, although NIO is still not yet profitable. For the first quarter of 2021, NIO lost 48 cents a share as revenue swelled 529% to $1.22 billion. It has improved its gross margins quarter over quarter, and achieved a positive cash flow from operations. If you are new to this channel, welcome. We are making videos to analyze companies and provide information to help you understand what to invest. Please like this video to help the YouTube algorithm to increase this video's search ratio, and don't forget to subscribe to the channel. Without delay further, let's get started. NIO stock has fallen more than 40% since its 11th January high of $66.99. NIO stock moved between $38 and $41 despite it reporting delivery up more than 400% and revenue growth more than 500% on 29 April. The reason for the weakened stock price is due to the global shortage of chip supply. The worsening chip shortage briefly idled a NIO factory in late March and early April. Furthermore, the intensity of competition heating up in the EV market is one of the most concerns of investors. NIO faces rising competition from Chinese tech, local auto startups and the global electric car leader, Tesla. The EV competition is getting more and more intensifying. Tesla and German car maker Volkswagen are starting to sell made-in-China Model Ys and ID.4 for local car buyers. These two EVs are the main rivals to NIO's new EC6 model. Ford has also begun selling its new, locally made Mustang Mach-E electric crossover to Chinese consumers. This is not all. The Chinese auto giant Geely and tech giant Baidu are planning to jointly build EVs in China. Recently, Geely just launched a new luxury EV brand, called Zeekr. The Apple supplier Foxconn also eyes the EV market. On 4 January, Foxconn signed a strategic cooperation deal with embattled Chinese electric vehicle startup Byton Limited in a transaction that could mark a large bet on the car-making business. Meanwhile, China's BYD has launched its Han electric sedan. BYD is backed by Berkshire Hathaway chief Warren Buffett. BYD is one of the world's biggest EV and battery makers. NIO is a promising and fast-growing company, expanding its capacity in China, while looking to soon launch in Europe. On 28 April, NIO announced on Twitter its ambitions for a presence in Norway. 40% of the world's EV market is in China, and the other 40% in Europe. Hence, other than Chinese market, the European market is important for NIO to grow its global market shares. Beijing announced a 2-year extension to the subsidy program last March after sales of new energy vehicles recorded their first year-on-year drop in 2019, a slump deepened by the coronavirus. But EV sales apparently ended up exceeding year-earlier levels by nearly 10% in 2020, prompting the government to curb support and lighten its fiscal burden. At the beginning of 2021, China slashed EV subsidies by 20%, a move that could affect NIO. As the EV battle heats up, NIO is expanding operations to fend off its competitors. NIO is looking to increase EV production capacity to 10,000 units per month in the second half of 2021. It expects to reach 150,000 units per year in the first quarter of 2022. Currently, NIO is limiting its production to 7,500 units per month due to the global chip shortage and robust demand for its new, longer-range batteries. NIO's key growth drivers include the EC6 and ET7 models. The ET7 electric sedan could be the first EV to offer a solid-state battery and 600-mile range. The outlook for NIO's sales seems robust. NIO's plans to expand internationally promises more growth in future. China EV sales and global EV sales are very bullish, a positive for NIO. In 2021, EV sales are expected to rise more than 30% to 1.8 million units in China. Globally, EV sales are expected to rise 70% in 2021. Hence, NIO has a huge potential for growth. NIO's advantage not only is it a local EV manufacturer in China, its battery swapping technology enables its car and battery to be sold separately. Users can buy NIO EVs without batteries for a lower price and rent batteries for a monthly fee. Buyers also have an option to swap car batteries depending on their needs. This has provided NIO with a new recurring revenue source. NIO also expects to generate recurring software subscription revenue from its autonomous driving systems. Unlike Tesla, NIO does not manufacture itself. NIO partners with Jianghuai Automobile Group to build its luxury electric SUVs. This is an advantage for NIO as outsourced manufacturing will be able to reduce its cost curve faster as it does not need to burden by the huge sunk costs. The recent earnings reporting, NIO has reported strong earnings for the first quarter of 2021 despite the ongoing global chip shortage and the attendant slowdown in production. Its quarterly results and sales were above Wall Street expectations. But why did the strong earnings not boost its stock price? This seems to happen to other EV stocks like Tesla and XPeng as well. Well, investors have been eyeing the threat of rising inflation. Inflation expectations have risen robustly in the past several months. Investors currently expect inflation to run at above 2% for the next 10 years. The higher inflation forecast is causing some anxiety for stock investors. The short-term challenges faced by NIO will be the competition growing in the China EV market. Tesla is ramping up its made-in-China Model Y production, competing with the NIO ES6 crossover. The much cheaper Volkswagen ID.4 is now on sale in China, while the Ford Mustang Mach-E is taking pre-orders as production begins there. General Motors and other auto giants are ramping up their China EV plans as well. Meanwhile, NIO, XPeng, Li Auto, BYD and several other local EV makers are ramping up their own output. On 29 April, NIO was announcing the beginning of construction of NIO Park, a smart electric vehicle industry park it is co-developing with the Hefei government, ahead of the Chinese automaker's quarterly earnings release after the close Thursday. NIO Park is conceived as a smart EV industry cluster, encompassing R&D of vehicles, core parts and components and autonomous driving. It was envisioned to evolve as a pioneering innovation chain with global competitiveness and a hub for hundreds of key supporting industries and a highly clustered, full-fledged industry chain. The 16,950-acre park features three main function areas: smart manufacturing, R&D and living space, and Eco Park. NIO Park will likely contribute to peaking carbon emissions and achieving carbon neutrality. The park, according to NIO, will accommodate over 10,000 R&D personnel and 40,000 technical workers. It's expected to have an annual production capacity of 1 million vehicles and 100 gigawatt-hours. The annual gross output from the park is expected to reach 500 billion yuan, which is approximately $77.3 billion. This is important for NIO to embark on a broad push to drive volumes as it comes up against fierce competition in a crowded EV market. The chip supply crunch that hurt its production. The long-term challenges will be at some point in time, soaring output of eclectic cars could outpace overall demand, squeezing sales and prices. The supplies of batteries and battery metal will cause rising battery costs due to increase in demand. Lithium-ion batteries are an essential part of our everyday lives. They power our phones, laptops, tablets, and electric vehicles. Demand for lithium in the form of lithium carbonate and lithium hydroxide, the key ingredients in these batteries, are rising rapidly, up almost 20% in 2019. Prices doubled between 2016 and 2018 in anticipation of increased demand brought on by the EV revolution. However, the consistent increase in demand is militated against by the ongoing outbreak of coronavirus, the looming economic downturn, and the collapse of oil prices, making the future of EV sales uncertain. These are additional strains on supply chains. The EV battery supply chain faces a number of obstacles, including high costs and environmental concerns associated with the extraction and processing of key metals. Today's low prices, which reflect an overestimation of short-term demand, will also hurt investment in future exploration and production projects. We could be witnessing the beginning of structural undersupply of key battery materials, which will have a significant impact on EV manufacturing. Current trends suggest a shortage of raw cobalt in the future. The current capacity to mine will not be able to meet growing demand. With sales of EVs predicted to grow this decade and beyond, manufacturers will need to find a way to either ensure a continuous supply of cobalt and lithium or find viable alternatives. NIO stock is in a bear market now, hence you would not be able to see a huge jump on its stock price in the short term. However, NIO stock is for long-term investment. NIO stock price will pick up again in 2 to 5 years' time. In a nutshell, we expect NIO to grow into its valuation over time. We predict that NIO will emerge as a major winner in the China auto market, therefore we believe NIO is a must-own stock for growth-oriented and ESG investors. This is not financial advice. The content of this video is intended to be used for informational purposes only. It is very important to do your own analysis before making any investment. Thank you for watching. If you like this video, please give a thumbs up, else, please leave us comments to help us improve our videos.